Look at the sequence clearly. Trading was halted at 12:15 Central Time on Wednesday. Silver was trading at 91.30. Markets reopened roughly 1 hour and 35 minutes later. The moment trading resumed, price dropped straight to 88. No bounce, no pause, just immediate selling pressure as soon as the market reopened. Now silver is back near 89.20, holding what used to be resistance in previous breakdowns. That level has now flipped into support. The structure is speaking. Money truths here. Copycats everywhere. Cloning the format, using my name, pushing scams. I sell nothing. No courses, no memberships, zero. Money truths on YouTube and X. That's it. Data hits X when it breaks. Analysis stays here. No paywall anywhere. And for the new viewers, understand this. Those metals influencers you follow, the ones selling premium signals and paid communities, they're watching this content, listening, and taking notes. That's not speculation. That's reality. If this sharpens your perspective, comment money truths, or just input below, so I know who's actually paying attention. Now let's break down what really happened, and why the timing matters more than the official explanation. CME halted all metals and natural gas futures, trading Wednesday afternoon. Official explanation, technical issues. Natural gas reopened at 12:50. Metals didn't reopen until 1:45. That's roughly 90 minutes of frozen markets where nobody could trade. No buying, no selling, no price discovery, just locked pricing, while global markets continued moving. Here's where things become interesting. This is the second major CME disruption this month. In the first week of February, settlement prices were delayed. Now, we have a full trading halt. After nearly 5 years without significant outages, 2 events occurred within 3 weeks, and both times silver was building momentum toward major resistance. When trading resumed, silver instantly dropped $3 to 88. Gold dropped $70 to 51.64. Not gradual selling, immediate pressure that felt coordinated rather than organic. CME canceled all-day orders and good-till-date orders. Only previously acknowledged good-till-canceled orders remained active. That effectively reset the order book in a way that favored institutional participants who could react instantly, while retail traders were still trying to understand what had happened. Silver was approaching 92 before the halt. We discussed that level in earlier breakdowns as the next upside target for, price had already broken above 89, held it as support, and was building momentum toward that 92 threshold. Then the halt occurred exactly as price tested that level. Strangely, these technical failures rarely appear when prices are falling. Shanghai pricing tells a completely different story from Western markets. Shanghai spot traded near 101. SHAFE, futures near 106. Western spot near 89. That creates roughly a $12 premium on spot and nearly $17 when comparing Shanghai futures to Western spot pricing. That gap reflects physical demand strength in Asia versus paper pricing pressure in Western markets. When that premium persists, and even widens during Western market disruptions, it signals something deeper than simple arbitrage and efficiency. Now let's move to the data that actually matters. COMEX registered silver dropped 2.2 million ounces on Tuesday alone. Total registered inventory now sits around 86.3 million ounces. Breakdown: 155,000 ounces withdrawn from Asahi, 167,000 ounces adjusted out of Brink's registered 647,000 ounces, withdrawn from HSBC 374,000 ounces, withdrawn from JP Morgan 80,000 ounces, withdrawn from StoneX. Some metal moved into Loomis registered, but the net result was approximately 890. 0 ounces leaving registered inventory in a single day. Every day, the number continues declining. Yesterday's 71 million ounce roll was the largest seen recently and relieved immediate March delivery pressure. However, what's missing is new metal entering COMEX vaults to replace what's leaving. Eligible inventory still exists, but it is not being designated for delivery. That distinction matters because the structural deficit extends beyond March. Here's something most people are not discussing. The February gold contract still shows roughly 4,000 open contracts. That equals about 12 tons, roughly $2 billion at current pricing. Contracts opened at the start of February should already have been delivered or rolled forward. They weren't. One participant still needs to deliver 12 tons against February obligations this late in the cycle. That is not normal settlement behavior. The real question becomes simple: manipulation or coincidence? Let's evaluate both possibilities. Scenario 1: genuine technical failure. Dates: Scenario 1: exchanges experience outages. CMEs operates extremely complex infrastructure. Natural gas reopened in 35 minutes. Metals required about 90 minutes, possibly due to additional system checks. The price drop after reopening could be explained by stop-loss cascades and leveraged liquidation events. Scenario 2: strategic intervention. The timing becomes suspicious when viewed in context. This is the second disruption in 3 weeks after nearly half a decade without major outages. The halt occurred 48 hours before March 1st notice day, while silver was approaching a breakout level. When trading resumed, the selling pressure was immediate and strong enough to push price down $3 within minutes. All-day orders were canceled, resetting the order structure in a way that favored institutional participants over retail traders. Jesse Livermore described this dynamic in Reminiscences of a Stock Operator, how those controlling market infrastructure always hold the advantage over outside participants. When you control the exchange, you control when trading happens. And when it doesn't. A well-timed halt can reset momentum in ways direct intervention cannot. Now, here's the historical parallel that matters. On November 28th, CME Group halted silver trading for nearly 10 hours. The official explanation was cooling issues. Silver was trading near 53.26 when the halt began. That halt occurred on first notice day for December silver delivery. Reports later indicated that a Chinese industrial participant had notified COMEX of intent to take physical delivery of roughly 30 million ounces. When trading resumed, silver moved sharply, spiking toward 56.78 and eventually more than doubling to 121 within the following 2 months. The cooling issue appeared exactly when delivery pressure was at its highest. The pattern matters. Trading halts tend to cluster around settlement periods, when delivery obligations are elevated and price is testing resistance levels that would accelerate covering pressure on concentrated short positions. Wednesday's halt fits that same structure, 48 hours before settlement. Silver approaching 92, registered inventory declining daily, persistent premium pricing in Shanghai. Now there's another development worth attention. COMEX open interest continues declining, while iShares Silver Trust is seeing steady inflows. That behavior reflects risk reduction. Capital is rotating from futures exposure into physically backed ETF structures. When traders prefer ETF exposure over futures contracts, it signals concerns about delivery reliability. You don't abandon futures unless counterparty risk becomes part of the calculation. Meanwhile, the Shanghai Futures Exchange suspended 25 trading groups during February for violating position limits. That level of enforcement activity is abnormal. Exchanges typically intervene only when concentrated positioning that begins creating systemic risk. When you combine 25 account suspensions, persistent Shanghai premium Western trading, halts, these signals are not isolated. They are connected. Now shift to the supply side. Mexico remains the largest silver producer globally, yet security disruptions continue increasing. Organized violence is making workforce stability harder and raising transportation costs across mining regions. Coordination efforts involving the Donald Trump administration and Mexican authorities may eventually stabilize conditions, but current supply risk from the world's largest producer is rising, not falling. Here's what the November precedent demonstrated. The halt itself did not cause the move. Underlying delivery pressure did. When physical demand cannot be absorbed through normal market mechanics, structural stress appears elsewhere. Inventory withdrawals, premiums, enforcement actions, and sometimes trading disruptions. The halt becomes the symptom. Physical shortage becomes the cause. Once trading resumes and the underlying pressure remains unresolved, price acceleration follows. Now consider what could delay or suppress this structure. The March roll completed recently. Approximately 71 million ounces moved forward, relieving immediate pressure. Short positions can continue rolling into later months such as May and July. The Shanghai premium could narrow. Supply conditions in Mexico could stabilize. But the counterpoint remains clear. The roll completed, yet registered inventory continues declining. Physical metal keeps leaving the system. The Shanghai premium is not collapsing even while Western paper pricing experienced sharp selling pressure.
Ooh.
The structural conditions that existed before Wednesday's halt, delivery pressure approaching settlement alongside declining available inventory, have not resolved. Let's summarize the structure clearly. Silver was trading 91.30. Markets halted for roughly 100 minutes. Trading resumed with an immediate $3 drop to 88. Price is now near 89.T, holding former resistance as support. Shanghai premium remains near $12. COMEX registered inventory sits near 86.3 million ounces after a 2.2 million ounce decline Tuesday. March settlement arrives within 48 hours. February gold contracts still show roughly 4,000 open, about $2 billion. That should already be settled. This marks the second CME disruption within 3 weeks after nearly 5 years without major outages. COMEX open interest continues declining while SLV inflows increase. 25-ish trading groups were suspended in February. The November precedent showed a halt on first notice day, followed by a 2.5x move when delivery pressure remained unresolved. Pull the vault reports. Check the Shanghai premium. Verify the February gold anomaly independently. Jesse Livermore explained this principle in Reminiscences of a Stock Operator. Most participants avoid information that contradicts what they already believe. Verification requires confronting uncomfortable data. Most won't check. They'll dismiss instead. Those who actually study the structure don't need convincing. This is financial warfare education, not investment advice. Invest with logic, not hype.